it's a very difficult environment for investors to make a decision, because we have inflation that, as we said before, remains elevated, almost 4%. We have the economy that is decelerating, obviously. We have a conflict on the making in the Middle East. And investors are expecting that the Federal Reserve will not do anything anymore. But we cannot really exclude that, because in the past 18 months, the Federal Reserve has been doing what the market was not expecting to be done. Like if we take, maybe now I'm going a little bit more technical, but if we look at the SOFR futures, the SOFR futures basically indicate what's the expectations in the future for Federal Reserve interest rates. So on the back of the SVB crisis in March, the 3-month SOFR futures for December 2024 was showing expectation of the Fed fund rate to be at 2.7%. Now we are at 5.5%, huge cuts in 2024. But that went from 2.7% up until 4% recently. So basically what this is telling us, that our market expectations build in daily, and things can change, but whatever the market is pricing might be wrong. And the market was wrong clearly in March, because right now we are in a completely different situation. And the market might be wrong also today, right? The market now is pricing not only for rates to drop to 4% in 2024, but is pricing rates to remain around 4% for the next 10 years throughout all the curve. And then, actually to rise slightly, I think like in 2028, 2029. That might be still wrong. So as an investor, it's very important to understand where are markets' contradictions and try to trade with them.
Interesting. I'm just thinking when you're explaining this that, so many people always try to predict the future and looking at the data they have today to make an analysis on what will happen, in 5 months and 10 months, etc. Giving all the data you have in your head and all the things you have seen, how hard is that exercise to predict with certainty what will happen, even in bonds and and in instruments you would think is a bit more stable than maybe a volatile stock?
I think it's impossible, Chris. The problem is that it's very easy in finance, like in life, to jump into conclusions. For example, this week the war between Israel and Hamas started. And there has been a lot of people that jump to the conclusion, the Federal Reserve is done, is going to cut rates, or, like the US is going to enter in a conflict. But realistically, as a strategist, you have to pick all these views with a pinch of salt. To me, a war between Israel and Hamas just means that we are heading towards a period of high volatility and high uncertainty. And how do I position for that? If I want to hedge my position and I want to lock in the best risk and reward ratio, for me is trying to keep quality and to limit duration risk. And the only way to do that is trying to get, like very well-rated investment grade corporates, US treasuries, the safe haven, but remaining in the front part of the yield curve. Because it is true that if the Federal Reserve engages in interest rate cut environment, the long part of the yield curve, so I'm talking like ultra long, 20-year plus, is going to drop. But we don't have the certainty that that's going to be the Fed's next step. And with the US inflation at 3.7%, and interest rates at 5.5%. You know, the market still working as a whole, the economy still recording, expected to end the year in positive growth. I don't see why the Federal Reserve will need to cut rates. And if it does, then at that point, you can take on more risk. But so far, you know, uncertainty, volatility, you know, my first impulse is the one to limit risk.